Hello, we are live. And welcome everyone to session 9, our final session of day 1 here at the Modern Investor Summit. So I'm Reda Farhan, Global Markets Analyst at Finimize. And to close out the day, we have a powerful session lined up on how to navigate high-risk trading in 2025. Joining me today is our expert speaker, Edward Egelinsky, Managing Director, Head of Sales and Distribution at Direxion. Edward brings a wealth of expertise from Direxion, a leader in leveraged and inverse ETFs, helping traders capture quick market movements with precision. Ed, it's a pleasure to have you here with us today. How are you doing?
No, great. You saved the best for last. Maybe some people know the Vanessa Williams song. I will not sing it, although it's late right now in some spots. So that's as far as I go, but I'm happy to be here.
I was hoping you would. What a shame.
We'll see how the session goes.
Absolutely. Well, before we kick off, just some quick housekeeping rules for everyone. First of all, a big thank you to Direxion, our session partner, for supporting this event. They are at the forefront of innovative ETFs. So to be sure to check out their ETF offerings if you're interested in using some of them in your short-term trading strategies. Second of all, if you haven't yet, please introduce yourself in the chat with your name and where you're tuning in from. Let's all be social. And then third of all, this is a 30-minute session, including audience Q&A towards the end. So to that end, please don't forget to submit your questions in the Q&A box below, and we'll get through them towards the end of the session. So without further ado, let's dive in. So Ed, lots to talk about, but maybe kind of starting off a bit high level, how do you think traders can manage the thrill, should I say, of high reward opportunities while staying mindful of the risks that come with leveraged and inverse ETFs?
Well, this is a great way to start the session. As you said in your question, these are geared as high risk reward vehicles. These are for sophisticated active traders. These are not for buy and hold investors. So somebody that's trading leverage and inverse ETFs, they need to monitor this on a daily basis. It's important to understand how leverage and inverse ETFs work. There is a reset of leverage on a daily basis. So whatever magnified level 2, 3x, it'll track for a given single day. But once you hold beyond one day, there'll be something called compounding. And that could work for or against you depending on the path of that underlying index or single stock during the time you're trading it. So these are in essence timing vehicles and a great way to express very short-term views, whether you're bullish or bearish.
Makes perfect sense. And okay, if I can kind of broaden out a little bit, and are there kind of key market signals that retail investors should keep on their radar to spot these short-term trading opportunities you're talking about, especially as we head into 2025?
Well, of course, if you look at post-election, there are a number of sectors that could be impacted by the new administration, and now it's controlled by all three branches, so maybe they'll get more done. The initial perception might be less government regulation within some industries, and maybe that favors also M&A activity. So there are a couple of sectors to look at. One is technology for sure. You could trade the broader tech sector on a short-term basis through tracking our S&P Select Tech Sector Index through our 3X Bull or Bear, TECL, TECS. There's a number of factors there in technology. What is going to be the level of scrutiny with AI? And we have ways you could trade a basket of AI stocks, Bull or Bear, through our trading vehicles. The CHIPS Act, for example, what's going to be the impact on U.S. and global semiconductors? Our most popular ETF is our triple leverage bull on the NYSE Semiconductor Index. So we have bull and bear there, SOX L, SOX S. And then you have what's going on with antitrust concerns for some of the Mag 7, including Google, Microsoft, and Apple. And we'll touch on that a little bit later in terms of leverage and inverse single stock. And then you have some other sectors, the healthcare, biotech space. Last week, some of you might recall that sector sold off initially on the HHS nominee. I'll get that out. Potential impact on big pharma and the vaccine makers, you might have more favorable M&A activity, especially when it comes to the pharmaceutical and biotech sector. And lower rates potentially could help some of the debt load of biotech companies with higher R&D costs. So there are a number of ways you could trade that too. We're seeing some recent activity in our triple leverage bull on the select sector healthcare index known as CURE, aptly named, and then the triple leverage biotech bull or bear. We're seeing action in both LabU and LabD. Another sector, the energy sector. You have Trump coming to office. Drill, baby, drill is the mantra there. So you could see an even more increase in production within the U.S. The possible restarting of some pipeline initiatives, and maybe less emphasis on alternative energy solutions. You have geopolitical risk, of course, the ongoing conflicts in the Ukraine, Russia, and the Middle East. What's that going to do to oil? It's interesting this year, energy stocks have outperformed the physical commodity itself. So there are a number of ways from a short-term perspective you could trade energy stocks. And we have a 2x bull and bear on the mega cap energy off of the energy select sector index. And then for those that want to trade a little more granularly, the oil and gas exploration and production index, a 2x bull and bear, aptly named Gush and Drip. One of the things I also wanted to mention, communication services, Meta and Google. What's the extent of the social media crackdown going to be? What's the impact going to be on those individual stocks? There's a number of ways you could trade that, including our leverage inverse single stock. And today, when you look at South Korea, we're seeing a lot of interest in our triple leverage bull that tracks the MSCI South Korea equity index. It's the first time in over 40 years that South Korea enacted martial law. Also, when you talk about the emerging markets, look what's going on with China, for example. What's the impact of the new presidency going to be, and the potential impact on tariffs? So we're seeing a lot of traders taking positions short-term, bull or bear, on the FTSE China 50, which is known as yin and yang. So a lot of activity going on, a lot of sectors that you could look at. And depending on the market environment day to day, there are tools that you could utilize, whether you're bullish or bearish, to take advantage of that.
Amazing. So basically taking views on certain sectors and then using things like leveraged or inverse ETFs to kind of implement those views.
Exactly. If you're looking on a longer term basis, of course, there's non-leverage ETFs on all the sectors that I referenced that'll be a better representation for somebody that's more strategic asset allocation longer term. But for those that really have a short-term view, here's a way to express that through either a leverage bull or what we'll call inverse or bear fund.
Makes perfect sense. So we talked about how you can use ETFs to implement tactical views on specific sectors. Now, perhaps I want to ask if there are certain tools, tactical ETFs, that can help investors more broadly in terms of protecting their portfolios while still being able to jump on opportunities during market swings.
Yeah, well, you have a number of inverse ETFs, and we have those on both broader indices as well as single stock ETF inverse. And the real purpose of these is to express short-term views if you think the broader market or a single stock is going down. You could hedge your long exposure on a short-term basis with an inverse ETF. The advantages of shorting through an ETF is your liability is limited to your initial investment. It might be difficult to execute an outright short within an account because you have unlimited liability and the borrow cost could be high. So here's a way to have a short-term view on the market or an individual stock going down with an inverse ETF. In lieu of using options, for example, to hedge, here's another way you could do so through a packaged ETF. So these are short-term trading tools. We have a number of non-leveraged inverse ETFs, including on the S&P 500, SPDN, and also on inverse single stock on the Mag 7 and some others as well. So the lower leverage point on the inverse ETFs that are non-leverage, some individuals might use those tools maybe a little longer, but they should monitor them on a daily basis, even though they don't have leverage on the short side.
Makes perfect sense. And in terms of, risk management strategies, obviously these leverage ETFs, they move a lot more than the underlying. What are particular risk management strategies you recommend people to kind of implement when trading these? You hear about stop losses, etc. But from your perspective, what are some of the best ways to manage those risks when trading those leveraged ETFs?
Well, certainly to have a buy and sell discipline. You always want to live to fight another day. Some people use technical analysis, others use fundamentals, some use a combination of the two. We're agnostic in terms of which direction somebody would trade, no pun intended. So you need to monitor these on a day-to-day basis. But I think one of the things you want to definitely look at is headlines or other factors that you could base a trade off of if you think the movement of the reaction is going to be whether it's bullish or bearish. So always want to keep cognizant of what's going on in the marketplace, some fundamentals or some headlines you could trade off of. Some people use technicals, but again, you have to have a discipline. You got to realize that anything that you're trading, there's the risk that you could lose all your money in a short period of time, especially if you're using 2 or 3x products. But the most important thing probably is the education. First and foremost, you should go to our site, Direxion.com, to make sure you have an understanding of how leverage and inverse ETFs work before considering trading. And we have a whole section dedicated to that, an education section. So really, it's important for your viewers to be informed before they decide to make any trading decisions. And then Finimize has excellent educational content. So I would suggest to look at that as well.
Thank you. And, we've talked a lot about how to kind of implement those trades once you spot certain opportunities, trends, but maybe just taking a step back in that initial kind of phase. What are some of the best ways or, methods you use to spot those initial trends and then, making smart plays on them? But how do you spot those trends and come up with those views in the first place?
Well, we don't express any views. We have the tools for people to express the views. So that's where I would say do your research, be informed. So for example, there's a lot of activity going on right now in treasury bonds, U.S. treasury bonds. And one of our more popular ETFs is a triple leverage bull on the 20+ years index, on the bond index, TMF. Now, there's a lot of things you could trade off of there. For example, some economic data, the CPI or PPI, pre and post those announcements, the PCE, which is probably the preferred Fed inflation barometer to use, job numbers. We see people trading pre and post the Fed meeting or after Fed minutes. So these are the type of things from a headline perspective that you could trade very short term in an area like treasuries, the 20+ year treasury in this case. We also have the 7 to 10 year if somebody wants to trade the shorter end of the curve as well. So those are the type of things that you want to look for when you're trading, let's say, just as an example, the treasuries leverage bull or bear. And for your viewers, of course, when you think of bull, when you think of bonds, it's an inverse relationship. So you're looking for bond prices to go up and yields to go down. In the case of a bear product of our bond ETFs, that's where you're looking for rates to go up and bond prices to go down. So there's an inverse relationship there. It's not the typical bull and bear like you have with equities or single stock. There's an inverse relationship there. Your viewers should know that. Regardless, when you're looking at trading things like treasury bonds, for example, in the case of leverage and inverse, these are tactical short-term trading vehicles that you're trying to express a short-term view on which way interest rates are going. These are not income vehicles that you're holding. That's where you would buy things like TLT or IEF. Those are non-leveraged ETFs. I'm not passing merit on them, but that's a 20+ year treasury, very popular, and the 7 to 10 year treasury, IEF. There's still risk there, interest rate risk, but there's no leverage associated with that.
Makes a lot of sense. And actually, speaking about bonds and the Fed, maybe a two-part question. So first of all, how do you think potential rate changes could shake things up in the leveraged ETF strategy space? And second of all, and from my kind of own understanding and for viewers' understanding, how do interest rates impact your leveraged ETFs? Because when I hear about leverage, I assume you borrow money and you invest more. Is that the way your ETFs are constructed? If not,
Well,
how are they constructed and how are they impacted by interest rates?
That's a good question. Let's take a step back in terms of just how the structure of our ETFs work. We actually, on a bull fund, if it's an index, will either own the basket of stocks or physical ETF that tracks that index, as well as what's called a swap. And that's where we get the leverage. It's a derivative that we use, and we work with some of the biggest financial banks that every day provide us the daily return, market on close of that underlying index or single stock. And then there's usually a portion in cash as well. But your liability is limited to your initial investment. And in a case, let's say, of a triple leverage product, let's say a triple leverage bull fund, it will give you the 3x return of that underlying index for a given single day. After that, there's going to be compounding, and it's path dependent, meaning if the trend is going in your favor, that leverage could work for you. However, if it's a choppy market or something's going down, your losses are going to be magnified if you look to hold these for a period of time where the trend is going against you. In a bear fund, it consists of just a swap inverse of that index or single stock. So that's how you get the leverage, and the balance is in cash. We get a lot of questions. Nobody should be in this for any sort of dividend income that's paid out. But people ask how inverse funds have an income distribution at a given quarter end. And where does that lie? It's a lot of cash on hand in that ETF structure. As a result of that, could produce some income on the collateral because treasuries are now yielding something. And if interest rates go higher in terms of those borrow costs for the swap, that can impact it in terms of the cost being a little higher. But if you look at the fees, whether it's execution costs, swap costs, or our fixed fees, in a lot of cases, it's 95 basis points on an annualized basis. You can see that we're netting on a given daily basis when you're tracking whatever it is, that underlying index, whatever leverage point, pretty close on a daily basis to what the intended index is or single stock. So I think these are a cost-efficient way to get exposure. They're higher fees than a typical ETF, but these are not designed as buy and hold. If you don't want to use margin, here's a way to get exposure to leverage in a packaged ETF. And also with margin, of course, you're going to have to pay some sort of interest rate fee. And depending on the size of the account, it could be more costly in some cases than others. In the case of shorting, as I mentioned, you could do an inverse ETF. It's a packaged ETF. Your liability is limited to your initial investment. Not the case if you have the ability, and most accounts won't, to outright short, where there are borrow costs associated with that, and then the unlimited liability if that goes against you. So here are package solutions for an active trader to either express a leverage view to the upside or a bearish view to the downside.
Makes perfect sense. Thank you very much. I have perhaps one final kind of concluding question before we move on to audience Q&A. And if you haven't already put your questions in, please do that. Really final question, Ed, kind of like a takeaway question. So if you're a retail investor planning for 2025, what is the key piece of advice or takeaway you would give to these retail investors to incorporate into their strategy heading into 2025?
As I said, do your homework, have a complete understanding of how leverage and inverse ETFs work before trading, gather information to make informed trading decisions. I think your last speaker spoke about that. Just don't rely on ChatGPT. Do your own homework for that before you make a decision. And as I mentioned, with these type of trading vehicles, a disciplined buy and sell approach. And whether you're using technical analysis or fundamental analysis or a combination of both, have some sort of discipline. And leverage and inverse ETFs are not going to be for everybody. They're high risk return vehicles. So you need to be aware of that and only trade what you could afford to lose. That's what I would tell traders. One thing I did want to mention, though, which is becoming very popular, I just wanted to take a minute, the leverage and inverse single stock ETFs. We're seeing a lot of interest from retail traders. We have bull and bear products on the Mag 7 and beyond. Each of these are individual single stock, leveraged to the long side, 2x on the bull side, non-leveraged inverse on the bear side, on all the single stocks on the Mag 7, and some additional chip makers, including Broadcom, Micron, and Taiwan Semi, and then the outlier, the social streaming giant, Netflix. So we're seeing a lot of interest there. Tesla, TSLL, and NVDU are two of the more popular ones. Those are the 2x bull on Tesla and NVIDIA, respectively. So wanted to just cover that because that's been a huge growth area for Direxion, only been evolving the last couple of years. Keep in mind, though, with leverage and inverse, any single stock, there's additional concentration risk because you're just a single stock versus a broader index if you're using leverage or inverse on a broader index versus a single stock.
Very well said and described. Thank you very much, Ed. I want to switch over to some of the questions where we have from the audience. First one is, if the general expectation is for the market to rise, why not just use leveraged ETFs in your regular savings plan?
Well, again, if you're looking at this from a long-term perspective, it's because of the reset of leverage on a daily basis and the compounding impact. Just to give you an example, we have triple leverage bull and bear funds of the same index, tracking the same index, that over longer periods of time, depending on the path of that index, could both be down. So you just can't set and forget these. There is the reset of leverage on a daily basis. There's going to be a compounding impact. These are path dependent, meaning the trend is your friend. So really, it's a timing vehicle, and that's why they're not designed for buy it and hold it indefinitely. You're not getting a 2x or 3x cumulative return over holding, let's say, the S&P 500 over a course of a month or 2 months or 3 months. That's not what these are designed for. Buy SPY, buy some other type of non-leveraged ETF that gives you that broad representation that'll have a lot of volatility, but won't have the potential negative compounding impact of a leverage vehicle with the daily reset of leverage. So these are not designed as, I'm going to set it and forget it. These are trading vehicles. I can't emphasize that enough. The timing matters with these vehicles and can make all the difference in terms of getting a magnified return that you would expect if you hold it past 1 day, or losing the majority of your initial investment because your timing's wrong.
Makes sense. Thank you very much. And then the next question is, do you believe current regulations adequately protect retail investors using these products?
Well, I think our education and working with groups like Finimize, we certainly have enough disclosure and education. In fact, that's dedicated within our site, a section to leverage and inverse education. I think it comes down to you have to be your own advocate for any sort of investor, whether it's options, Bitcoin, whatever you're trading, to at least have an understanding of the risks associated with it. And I think we do a good job of conveying that. And so do the retail trading platforms that a lot of these retail investors are utilizing. But you have to be your own advocate. You have to do your own homework. And please visit our site. It's all the more reason to educate yourself before you decide to trade any of these.
And do not rely on ChatGPT, as you correctly said.
Great tool, but I don't think for your investing purposes, it may be a tool you use as a reference point, but to make investment decisions, nevertheless trading decisions, I think you should have other disciplines to utilize to make that work for you. Unless you're in the business of having a trading system and programmer, and you do it for a living, that might be a different story of how you use AI. But for the average retail investor out there, AI is a great tool, like that last guest said, but it is not something that you should be relying on to make trades.
And there goes my random walk ChatGPT agent. I will know where to navigate. Next question. What are some interesting areas to explore for the Santa Claus rally over the next few weeks?
You know, this market's gone up a lot this year. Valuations could be a little toppy. We really don't get into opinions. That's why we have bull and bear vehicles. But maybe some areas that have shown some signs of life post-election. Most of the sectors have, but you've had some things that have underperformed. For example, I mentioned before, healthcare and biotech have sold off a little bit, haven't really participated in this rally so far. And then you've had small caps showing some signs of life last month, for example, leading the U.S. broader indices. So, you know, if you're a contrarian, there's some things to like as you get towards the Santa Claus end of the year rally. A rising tide may not lift all boats in this case, because you've had such a tremendous run up in the market, particularly in areas like tech and the Mag 7 for quite some time. I think you really need to look at valuations too, whether it's short term or more on a longer term basis. You know, multiples are going to matter at some point. You know, they may not matter today, they may not matter tomorrow, but at some point, you know, things that are overvalued at some point might come back more into what the mean is, their historic mean.
I mean, considering how creatively named all your ETFs were, I was really hoping you'd have a 3x ho 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 ETF for the Santa Claus rally.
No Christmas tree lighting or holiday festive ETF. Yeah, maybe you know, consumer discretionaries for that, if you really want to go there on the. It's going to be a good holiday season, but again, short-term trading vehicles. So if you get these retailers that are coming out with some news and you look at the basket of stocks of, let's say, the consumer discretionary sector, maybe it's a trade. Or if you think longer term that the consumer is going to hold up, maybe look at a non-leveraged ETF that could benefit from that.
Makes sense. And the next question is basically asking, how liquid are leveraged ETFs compared to normal other ETFs, and how does this impact their trading?
It's a good question. I would say the majority of our ETFs trade very actively during the day. In fact, when there is some news out or just normal trading activity, we could have turnover of the total assets of a given ETF within a couple of days, if not shorter term, depending on the market volatility of that underlying index. So if you look at some of our ETFs, a lot of them are some of the most actively traded on a daily basis. So very liquid. You always should look at the underlying, though, whether it's a non-leveraged ETF or a leveraged ETF, what's under the hood. You know, the S&P 500 probably looked at a little differently than the FTSE China 50. So you should do your homework there in terms of the underlying exposure and what that index consists of and what's that underlying liquidity. But when you look at our leverage and inverse ETFs, they trade very actively, and they're always amongst the most active traded, a lot of them, and they have a lot of turnover, and that's what they're designed for. So I think just the fact that how we're telling people to utilize these, or at least what we're recommending in terms of these are short-term vehicles, every day's a new day, you got to monitor on a daily basis, is reflective of the high turnover of the trading day-to-day of our ETFs.
Absolutely. Thank you for that. And perhaps one final question before we run out of time. And I'm assuming this is in reference to, you know, your usage of swaps in these ETFs. Mm-hmm. So this question is basically asking, what is the counterparty risk on these funds? And have there been instances where the counterparty has not been able to deliver?
Well, that's something we have a risk team that's always assessing the counterparties. We have you know, at least 8 counterparties or big banks that we work with globally, and some of the bigger names that you probably know that are some of the biggest in the space. We also have certain structures in place that limit if there was an overnight situation, because it would be the exchange of payment for that given day within a swap, to limit that risk. So we structure the accounts to where If somebody did go bankrupt that we had as an underlying swap, number one, we diversify in terms of the swap providers within an ETF. So we spread that out that way. And number two, the margin to equity of the total assets is a smaller amount. And then we have structurally set up to where really it would be a minimal percentage. But if somebody did go bankrupt and we had a swap with them, yes, there'd be some risk there.
Amazing. Perfectly clear. Thank you so much. That's a wrap. I'm afraid we're out of time. Ed, first of all, massive, massive thank you from myself, the Finimize team, and our entire community and everyone tuning in. That was extremely insightful. I know I definitely learned a lot. I hope all our viewers did as well. So thank you, Ed, to you and all the team at Direxion.
That's great. Thanks for having us. Happy holidays.
Happy holidays indeed. Thank you so much, everyone. That's a wrap. That's the end of day one. And hope you enjoyed all the sessions today. Don't forget, we have day two tomorrow with lots of great speakers and lots of cool sessions planned as well. But for now, thank you once again. Hope you have a great evening, and we'll see you all tomorrow.